Good morning, everyone. Thank you so much for joining us. My name is Cassie Hopkins, and I help coordinate the webinars and events for Hausman Johnson Insurance and the Benefit Services Group. I would like to welcome you to today's webinar, Is a Captive Insurance Right for You? This webinar is interactive, and it's going to feature a question and answer session. You can type a question in during the webinar, and John will address it during the Q&A portion of the presentation. After the webinar is over, there will be a short survey we are hoping you can fill out for us to give us feedback on the webinar, as well as webinar topics you are interested in learning more about. This webinar will be recorded and will be available on the webinar archives section of our website. And each one of you will also receive a follow-up email with a link to the recording, as well as a copy of the presentation slides. I would now like to introduce you to our speaker, John McHale. Mr. McHale oversees all aspects of a distributor-owned group captive program and also assists with 2 multiple class group captives. Duties include reporting responsibility to the captive's board of directors and oversight of the various service providers who assist these programs. He also conducts prospect development and provides assistance on risk control and financial activities to improve each member's captive experience. Since his joining of Captive Resources in 1999, the distributor captive has seen its overall premium growth increase 7-fold to over $50 million in premium with approximately 145 active members. The multi-class captive that he assists with has also seen similar success and today is over 130 million with 200 members. He is also active in a third multi-class captive that is less than 2 years old with 12 million in premium and over 40 members. These programs provide control to their members for all aspects of insurance with excellent dividend opportunities. They include coverage for workers' comp, general liability, and automobile for clients who want better control over their insurance costs. Welcome, John, and thank you so much for joining us.
Thank you for having me. Well, I will get started. Cassie, you can hear me fine?
Yes, you're good.
Okay, then I will kick this off. Again, I work with Captive Resources. Been doing this for about 22 years now. And what we wanted to cover today as far as an agenda, a little bit overview on how the captive differs really from traditional insurance, which more than likely most of the participants are part of today. So get into the weeds and the mechanics of how they work. Actually go through a couple of loss examples depending on our timing. I can even share some recent, what we like to do are oftentimes 5-year look backs where we can actually show, plug in your actual losses and try, kind of figure out, where you would be had you been in the captive the last 5 years, how that would have looked for you. So we'll see if we have time for that. Go through a little bit of the financial requirements because it is a different mousetrap, a different approach. So there is going to be a buy-in because you're essentially becoming a insurance company owner, and there is going to be collateral, which is required because there is some risk to the captive, meaning you can pay in additional dollars above and beyond your normal or your go-in premium if you have a bad loss year, especially a lot of frequency type claims. And then as Cassie mentioned, we can conclude with some questions. Hopefully you're welcome to put those in throughout the sessions as they pop up. And then Cassie will go through those at the end and hopefully we can take care of all of those questions. Captive Resources has been around for 35 plus years. And technically, we're an independent consultant. So we piece together the various service providers, and there's, a full team that's involved with any captive. The biggest components are the fronting piece, meaning that they're going to issue a policy. We're working with a carrier that you guys have all heard of. I work with several different carriers, Zurich, Old Republic, names that you've heard of. But we also piece together the other players, claims services, the risk control service. Every captive has its own network of brokers. So Hausman Johnson has access to the the captives we're talking about today. As Cassie mentioned, the multi-company programs, that's what we're going to focus on today, just because for most of the folks on the call, you'll have probably your most likely best access will be to those diverse type captive programs. So we have 42 different programs. They all work very similar. The difference, again, is going to be who the service providers are. The broker networks are going to differ in some cases on different captive programs. And overall, there's about 5,000 members, or actually over 5,000 combined premiums, close to 3 billion. And the nice thing about working with captive resources, we've been doing this in this space for as probably longer than anyone. And because of that, we've got some pretty good size, which allows us in this last bullet point to provide investment income. So there is a vehicle that all of our captives share called the Captive Investors Fund. It is now, actually, this is a little outdated, but it's over $6.5 billion in total assets under management. And having that size and that scale, we're able to attract very good fixed income managers, very good equity partners that have given us returns since inception of 6%. What that means to you as your dollars are offshore, because all of our captives are based in the Grand Cayman, they're going to continue to work for you. You're going to still get investment income, same kind of perk advantage that insurance companies oftentimes live and die on, because they know that it takes multiple years for your claims to get paid out. You get that same advantage with our programs, and it's a very sizable and attractive returns. So let me get into the definition, what a captive is. I've kind of mentioned before, ultimately you guys are becoming an insurance company owner that provides insurance back to yourself. So you're in that driver's seat, you're in the control position, and it's not unmanageable. I mean, I was on a call yesterday with a prospect that was worried that, you know, they're going to take on way too much on themselves, and the captives manage that by really putting in, and what I oftentimes tell companies is it's almost like being self-insured, but with a lot of airbags. The first airbag is yourself. If you guys do a good job, you're going to have more of your money come back, because the majority of your money are monies that you're paying in for premium are sitting in dedicated loss fund buckets. If you don't use those dollars, they come back to you down the road in the form of a dividend. So the first control is you. The second control is your fellow members. We're going to focus on one of the captives called Summit. Again, it's a multi-company, multidisciplinary type program. As a group, they collectively take the first 500,000 of every claim. However, an individual company member or captive member wouldn't have to pay all 500,000 of a claim necessarily. So you do get help on the larger claims from your fellow members. So that's kind of your second airbag. And then of course, the third airbag is one of the service providers is a reinsurance company. And so any claim that exceeds, in the case of Summit, 500,000 is going to be pushed to the reinsurance company. So you've got multiple kind of airbags so that you can manage the risk portion of it, although ultimately you are jumping into a risk reward type program. Most years you're going to get the rewards, meaning that you're not going to use all your loss fund buckets, and you're going to get those dollars back as a future dividend. Occasionally you're going to have that bad year where you may have to pay in additional dollars up to a known cap. So we'll cover all that when we get into these different loss examples. Again, if there's still some confusion on how this compares to traditional insurance, I think one of the big things is the pricing. A little bit later, we'll talk about how we price it. But if you're in traditional insurance, you're heavily influenced by market conditions. If any of the folks on the call have any kind of transportation, fleet exposure, They know that because auto rates are through the roof. And they should be, because there is a lot more distracted driving when there are really severe, significant claims that involve a lot of property damage or injury to other people. They tend to get very high verdicts. So the insurance market obviously tends to overreact and charge everybody because they are getting beat up on a few accounts. So pricing is much more influenced by market conditions as compared to a captive, where we still have, it's done by an independent actuary, and we have members that have seen rate decreases on their auto line because they've done a good job with it. So it's all about what your 5-year history is in order to figure out the pricing component. Again, traditional, I say no risk. Obviously, if you have a bad year, a couple of bad years, the carriers can certainly move you out or at least increase your insurance premium the following year. In a captive, it's much more risk directly involved if you do have that bad loss year. But most years you're going to get the reward side of the equation. Now, we're not for everybody. So if we get a submission in, or we're talking with a broker that's got a client they want to look at, and let's say they have 3 or 4 tough years with high losses out of 5, that's not going to be a fit for the captive. Typically, in a 5-year picture, because we're always looking at your prior 5 years of loss history, the typical poster child would have a good year, a bad year, and 3 average years. So 4 of the 5 years are above average, and the pricing is going to make sense. So we'll be working with the brokers to make sure they're bringing us the correct accounts. Again, traditional, obviously you have control to influence with your safety program, but in a captive, that control is much more in your hands in terms of the pricing, because if you do a good job on your losses, that's going to improve your pricing. You can also impact who the service providers are, because the service providers are changed and corrected by the board, which you would be part of the board. So if they aren't doing what they need to do, any of the players can be changed out. The broker piece is really the same. It's just a little bit different mousetrap in a captive. So we do like to work with brokers like Houseman Johnson that are comfortable with the captive concept and know some of the nuances that come up that are going to differ from traditional. And you should expect to participate more, because in a captive, you want to participate more, especially because that'll have a direct impact on reducing your rates, getting bigger dividends. So there's a lot of different captive programs out there. For the larger companies, this is nothing new. The single parent programs were limited to the larger Fortune 500 type companies. That's where we differ. We actually cater toward mid-sized companies. If we switch gears into rent captives, or large national agencies also put together these captive programs. And in both cases, rent-a-captive is kind of administered through an insurance company, as well as large agencies would provide it. And in many cases, they are also involved on the risk-reward side, meaning that they're going to take some of the profits. They're also going to take some of the risk, which differs from ours, which are considered group captives, in that we differ from singles because we're going for mid-sized companies. And we differ from the bottom two in that we have no ownership stake, nor do any of the service providers. So Houseman Johnson, ourselves, the various insurance companies and reinsurance companies, they're all getting paid a fee, but they're not involved with any of the profit sharing. They're not taking any of the underwriting profits, and they're not taking any of the risk, with the exception of the reinsurance, because we'll cover that here shortly, where basically they are on the hook for the larger claims. And then in our world, the group captives come in 2 flavors. So you have homogeneous programs, which gear to one class of business or a very similar number of classes of business. And then you also have what I'll spend the time on today, the model on today, is a heterogeneous captive, meaning it will cater to a variety of different companies. So I'll be speaking quite a bit on Summit, which is a heterogeneous program. We generally say, hey, if you can get into a heterogeneous program, that's a good starting point. In some cases, the reason we have as many homogeneous captives as we do is because they couldn't get into a heterogeneous captive. So the homogeneous captives, for the most part, tend to cater towards tougher classes. We have a number of construction captives, a number of transportation captives, like a long-haul trucking. The easy example is we have a roofing captive under that construction area. Those are very difficult to get into heterogeneous captives, and like in the program I'm talking about, there's not even an option. That's why we set up multiple homogeneous programs, generally for tougher classes. We do, however, have one on the other extreme on the homogeneous side, and that's one that I work on directly. It's called EDIC. It's limited just to distributors. Distributors tend to be a more preferred insurance class because they don't have the big product liability exposures like manufacturers, nor as tough of a risk profile like compared to a contractor or a manufacturer. So we do have a lot of different homogeneous programs. Most of them are tougher classes. So getting back to the captive we're going to spend the time on today is called Summit. It's been around since 1994, so it's one of our older captive programs. Again, it is heterogeneous, so they've got a number of different industries that they cater to. So you got a very diverse profile of companies, which lets it grow more quickly because we're not limited to just one class of business. So 214 members, 130 million in total premium. The coverages, workers' comp, auto, general liability. Those are the only three lines of coverages that our captives cater to, and we'll talk more about that in a little bit, but it's just the casualty lines, comp, auto, GL. You do have to have a minimum premium of 400,000 to join the program, and it does have a common renewal date of February 1st. All of our captives have different renewal dates. It doesn't matter from you as a prospect in looking at a captive. If you have a August 1st or a September 1st renewal, we're going to provide you an annual number for comparison purposes, and we'll also have a prorated number. So if you join September 1st, we'll give you a portion of the annual premium prorated to get you to February 1st, and then following year, you would be in sync, in line with everybody else in the group, renewing February 1st. Just to show you a little bit of a mix of, who's in that program in terms of industry type as well as number of members. So the graph or the pie on the left, from a payroll standpoint, manufacturing is the largest sectors. A couple of the other big sectors are service, so that can be all over the map. We've got a variety of different service companies and transportation related companies. So those are kind of the big sectors in terms of payroll. If you did it purely from number of members, actually transportation has the largest sector, but again, service is a big chunk, construction is a big chunk, and manufacturing from again, number of members. So what does it mean, or what are you looking, if you're trying to profile, do I fit a captive or not? Generally, loss history better than average. So if you do know your loss ratio for the last 5 years, and it's less than 50%, then you should fit the criteria. If you're less than 20 or 30%, then it'll make a ton of sense. So the lower the loss ratio, the better. And keep in mind, when you look at your loss ratio, it's important to cap any large claim, because people tend to remember rightfully so, the really large claims, but you need to cap every claim at 125 grand and then come up with your loss ratio. And if you're kind of in that 50% or less category, then it's going to make sense. We will look at your financials, so we need good financial stabilities. There's an independent financial analyst that's going to do a review. Obviously, safety, controlling your losses becomes important, so we want you to be fully engaged on the safety and claims management. And I think generally we get above average accounts that do a good job on that, but they come into the captive and they take it to another level. And they should, because they're going to potentially pay in more money if they don't. And they also know that they get the benefit of a lot of those dollars coming back to them. Summit did bump up their minimum premium to $400,000. Cassie mentioned at the beginning of the, or on the intro, I also work on a new startup captive. So when Summit over the years has bumped up that minimum premium, when they bumped it to 400,000 a couple of years ago is when we started a newer captive. It will actually go down to 100,000. So it essentially has the same service providers, but will take on good accounts that are 100,000 or better. So if you're on the call thinking, hey, I can't get to 400, we still have options for you there. Usually companies are frustrated maybe with claim handling, just the, where claims can sit idle for multiple years that they feel could be more aggressively handled. Obviously in a captive, you're much more in the driver's seat. You are going to work with an independent or an independent claims administration company that's not part of the insurance carrier. So they're going to work on your behalf, and if they don't, then they can be replaced. So they tend to listen very closely to our clients. We do customer surveys all the time, and all that gets reviewed as part of twice a year board meetings. So it is a long-term solution to insurance compared to what you're used to right now. Again, a couple more things on how the captive works. All insureds are owners, so everyone has an equal vote regardless of your size. 1 vote per member. We do, most of the captives typically have 3 committees where all the heavy lifting is done. That would include the finance committee, which tracks losses to premium, kind of records and tracks the history and results of the program year by year. Every underwriting year stands on its own. They do oversee 2 financial statements that are done a year. There's a underwriting committee that basically looks at assist on the renewal, looking at who the different service providers are, looking at the type of business that they want to write or not write. And then there's a risk control committee, which is kind of the police dog of the group. So if we do have members, outliers that I guess you could say aren't pulling the weight, ultimately they could recommend to the board to non-renew a member. So there are measures in place if we have companies that aren't doing a good job. They're not going to be aggressive on an account that had a bad year, but they are going to be aggressive on an account that had 2 or 3 bad years in a row and doesn't appear to be, doing what they need to from a safety or a claims management side to improve the program. Those can obviously impact your own dividends, so they are trying to incorporate any solid risk control into the captive. All of ours are based in the Grand Cayman. There's no corporate tax. They have very efficient oversight management. This is something they've been doing for a long time. So there's a lot more efficiencies because today there are options to do onshore captives. But again, this is something that they've been doing for a long time. And our early program started in the Grand Cayman. It's worked very well. It's kind of like, if it's not broke, why fix it? So we continue to start new captives on a regular basis, continue to use Grand Cayman as our corporate headquarters, and it's worked very well. Risk, as we mentioned several times, claims is critical, managing those properly, staying active, and even helping us grow the captive, because you guys know who's out there that would be a good fit. So we do get a lot of member referrals. Again, we don't know that your premium is going to be lower. Again, it depends on that 5-year history, but if you're in that right category, you fit that model with good loss experience, enough premium size, and then you're going to see better premium experience. I think maybe not as much on the go end, but eventually down the road. So at the end of this presentation, I do show a example of a member in Summit. It's almost a 20-year look back. And the interesting part of it all is the fact that they are able to get to premiums that they just wouldn't see in traditional insurance. And that's, a credit to them. They did a great job in controlling losses. But that's really the main purpose and advantage of a captive, is getting to rates that you just wouldn't see in traditional insurance. We're not immune from the market, but because we do have reinsurance, if we have a lot of reinsurance losses, we're going to see a uptick in our reinsurance rate, but we certainly are much more insulated from what's going on in the market. So again, we'll have accounts that have lower vehicle rates from year to year, even though right now that's one of the areas that's gotten big increases. So again, not immune from the market, but certainly insulated. Again, above average risk accepted, and taking advantage of various risk control and claims management programs. We do twice a year risk control workshops, which we encourage our members to go to. Those tend to be operations, HR type folks. Some companies have their own safety person, where the board meetings are and those are done throughout the U.S. Whereas the board meetings are done out of the country. We have to do that to keep our offshore status, and to keep our tax exempt status. And those tend to be more owners, financial people, and some of the other folks that I mentioned. But basically, we try to keep you guys fully engaged so that you know what's going on with the captive, and you're taking full advantage of different tools out there to keep your losses down. All right, so switching gears a little bit into the mechanics and how it works. I wanted to start by, again, covering the lines of coverage. I mentioned before, workers' comp, general liability, auto. Those are the only 3 lines of coverage. Years ago, some of the older captives, including Summit, had property. Well, property tends to be much more severity driven. So you can have really large claims. You can think about hurricanes. In California, they got wildfires that have been killing insurance companies. You could have a large plant that burns down. So those are big claims. The severity side is not a good fit for our lines of coverage, just because of the size of the claims, and the predictability is not as good either. Tougher to predict Mother Nature or a potential fire. So these are much more predictable lines. We do have a sister captive that does property. It's a lot different setup. It's not as much a risk reward. It's more like traditional insurance with a little bit of reward. It's got no risk, but our captive programs have a much larger potential reward, return, whatever you want to call it, and certainly some risk to it. So again, I'm going back to Summit because every captive is going to differ, and they're going to differ because in the beginning, Summit started out at 250. So they took on the first 250,000 of every claim. Over the years, they've increased that, and a couple of years ago, they actually bumped it up to 500,000. So they're taking the first 500,000 of every claim. If you want to look at that as the group deductible, that's fine. But the good news is that if you're a member, and it depends on how big your loss funds are, In most cases, when you have the larger claim inside that first 500, you're going to get help from your friends, and that would be the other members. So here in a little bit, I am going to dissect this captive retention layer into a member working layer. So it's in terms of how you pay out claims, and the way it's priced is different in the first 125,000. That's kind of our working layer, versus the second layer, which is anything above 125 to 500. And that's where it's priced as a group, because there's much more shifting and sharing, and that's where you would get help from the other members when you have the larger claim. So you'll see that when I get to the loss examples. Now, again, I'd mentioned none of the service providers take risks, and that's not really true, because the reinsurer does take anything in that light blue layer. So if a member has $1 million claim, the captive is on the hook for the first 500. The next 500 would go to Axis Re. That's our reinsurance company. Now, if it's a workers' comp claim, the laws require you to take unlimited limits. That's set up by the states. So you could have a $2 million workers' comp claim. Again, the captive is going to be limited to 500. The next 500 to Axis Re. And then actually, in our case, Old Republic comes back with statutory protection that cover the next $1 million. So you have unlimited protection on the comp. Your auto and general liability are going to stop at $1 million. That's the captive limit. And the other nice feature is, to the outside world, again, for the brokers on the call, all of this is on Old Republic paper. So it's an A-rated carrier, auto ID cards, certificates of insurance, all of that's going to say Old Republic. Ultimately, what Summit is doing is, we're a reinsurance company. We are reinsuring back Old Republic, even though on paper it's Old Republic paper, but we're saying, hey, we'll take care of the first 500,000 of every claim. And again, for the brokers, again, the placing the excess coverage, umbrella coverage, would be outside the captive. So depending on what individual companies' limits are, we would still be seeking outside limits from the outside market. Now, we do have some programs that are available to assist that area, but again, that's outside of the Summit program. There's also some what we call sleep easy coverage, because you can have, for example, a larger claim. Let's say you have a driver, since we'll stick on transportation, that gets into a tough, nasty accident with both workers' comp claim and a third party, another individual that was hit. And so we have auto liability and additional property damage for them. So when you have multiple lines involved, the captive is still only going to be responsible for 500,000 total, not 500 for comp, another 500 for auto liability. So the basket is, again, additional sleep easy coverage to minimize the captive from having a really difficult claim that could cause problems for the whole group. Same with clash, provides even more protection, but that would be less likely to happen. But if you have multiple members in the same area and they bump into each other and you have multiple lines, again, they're going to treat that as one occurrence. So one $500,000 for the captive as a whole. So again, this is looking at the captive from 30,000 feet. There's a lot of service providers to make this work. I've mentioned the fronting carrier, and we call them a fronter because technically you guys really are on the hook for the first 500, but Old Republic is saying, hey, we'll front you. It's going to be on our paper. They do take some risk on that statutory for the comp, but basically it's more of an administrative function that Old Republic be the fronting company. Reinsurance, they do take risk. Again, they're taking that larger claims, anything over 500 up to $1 million, they're going to take that. Then Gallagher Bassett would be our claims administrator. We also call them third-party administrator, TPA. We are typically, our captives will work with independent claim administrators that are going to work and are familiar with working with larger and mid-size accounts. Risk control, again, all these buckets are getting paid on a percentage of premium, but there's no ownership or no sharing of any of the underwriting profits because all of that's going back to the individual Summit members. Some are going to do better than others on any given year, but it's all about what your experience was in that specific underwriting year as to how much money will flow back to yourself, or potentially how much you might have to pay in if you had a tough loss year. So let's go into different losses in terms of different scenarios, how they impact you. Before we can do that, let's give a kind of an example premium member. It's basically fairly close to our average size premium. How did we get to 611,000? And again, I'm just taking a straight average of the group. It's somewhere in the 650 to 700 range right now, but we'll use this as our example member to go through a couple of loss scenarios. So the first component you can see there, the loss forecast, that's coming from the independent actuary. And my next slide will actually show it's broken into both a working layer to cover the small claims, or the frequency layer, we call it. And for Summit, that's the first 125,000. And that's the biggest chunk of that 385. But then there is a smaller portion in what we call the severity layer, or the B fund. So the A fund is taking care of the small claims. The B fund takes care of the severity claims. That's where you're going to get help from your fellow members, because it's priced as a group, not individually. Once we know that, we're going to add operating costs, and this will differ because, I mean, it will be the same for the group. This one is actually showing a little higher. If we exclude the broker fee for our Summit members, it's about 30% is in operating costs, 70% is in that loss forecast. So over 2/3 of your money would be available to come back. Operating costs, if I exclude the broker component, would be about 30%. And that's how we get to your premium. Now, we will have below line charges. A lot of cases, the broker will put their fee here, along with terrorism and state surcharges, which the state surcharges would be in a normal traditional policy. But in a captive, when we get to a proposal stage, this will be very transparent, and you'll have multiple line items, so you know exactly how much everybody's getting paid. And we keep it very transparent because you guys own the company and you want to know exactly where all your dollars are going. So let's dissect this loss forecast again, because the lion's share of your money is in that A fund to pay those small claims. So if you look at this example, we had a 385,000 loss forecast. Almost 300 of it is down here in the A fund. So it's not uncommon to see 70 to 75% of your loss funds down in the A fund to pay those small claims. And that's where the actuary spends most of their time when they price you up. So they're pricing you up, they're looking at your 5-year history, and they're capping any large claims. And that's how they're coming up with that number. It's a 5-year look back, and it will be a different rate for, you know, assuming you have auto, comp, and GL, you're going to have different rates for each line. When they jump to so that's all about the individual company, because they're putting their blinders on. The actuary, they're only looking at your numbers. Capping any of the big claims. When they jump up to the B fund, now they it's looked at differently. So each year at renewal, the actuary will come up, excuse me, with percentages. They will differ by line. So they're going to be, just to give a number, 45%, let's say. 45% of whatever's in the A will be in the B, and it will differ by line. but that percentage is derived each year at renewal by the actuary, and they're looking at the 5-year history of the group so that they can adequately protect when somebody has a big claim, because quite honestly, 90,000 isn't going to last very long. If somebody has obviously one $500,000 claim, it's going to blow it up, and that's where the other members would help out. So again, we'll walk through kind of a good, a bad, and a ugly year, because worst case scenario is not the big claim, but the year where you have a lot of small claims and you beat up that A fund. That's the risk part of the captive. So let's go through a good year first. So this member has 165,000 total claims. From a dollar perspective, individually, every claim, and this is the key part, is less than 125. So they're all going to come out of this member's A fund. So going to the accounting, you can see there the 165. All of it's coming out of this member's A fund. They've got close to 300 in the A fund. And come dividend time, it looks pretty good because you got 130 left over in your A. Your B fund didn't get touched, which got 90. And don't forget investment income, because we're not paying dividends at the end of the year. For the captive and for Summit, which is typical for most of our programs, it's about a 3-year window before we start looking at paying partial dividends on a given year. It's about 5 years after the year's over before we close out a year and return all of the dollars left over in that underwriting year. So you're going to have some time element there, and that's where this 27,000 becomes important, because your money, your leftover dollars in these buckets are going to be working for you. You are going to get interest income. In this case, this member made over half of their money back. They paid in a little over 600, and they're getting back close to 250. Now I will give a quick asterisk, and you'll see this on the next slide, but the one problem with this example is you're never going to see all 90,000 of your B fund come back. And that's because every year, most years, you're going to help the group, and then occasionally you're going to be the bad apple where you cause risk sharing to the other members because you have a big claim. So keep in mind, when we do a 5-year look back, we typically use a 5% of premium as far as what you can expect to lose if you're going based on our averages of our open underwriting years. So 5%, and this member was paying roughly 600,000. So you're looking at close to, or maybe a little over 30,000 coming out of the B fund on an average year, meaning that's their portion to help the other members. And then again, occasionally you're going to be the one that blows up your B fund and the other members will help you. But most years you're helping the group. Occasionally you're the causer, and this is the next example is going to walk through where you have a big claim and all that stuff occurs. So let's move to a catastrophic year. We're going to keep 150,000 of small claims. Key there, less than 125. So they're all going to come out of the A fund. But now we got $1 million hit. Now the first thing we know about $1 million catastrophic claim, 500,000 goes to the reinsurance company. So the Summit members only have to deal with the first 500,000, not the full $1 million. So let's look at the accounting. Again, you got this 295 A fund. You're going to add in your small claims, 150. And then we're going to deal with the large claim, which again is $1 million. We're going to take the first 125 of it out of this member's A fund. So they've got 20 grand left over in their A bucket. Where it gets a little more exciting is what happens up in the B, right? So this member already paid 125 from their A. Now we're still short 375. They only have 90 grand. So guess what? We're going to wipe that out. Nothing left now in this members B fund, but we're still short 285 grand. So hopefully everybody followed the math there. And that's where the other members come to help you out, with one slight wrinkle. And that is the fact that this member still has 20 grand left in their A fund. And so one thing that all of our captives have gone to, again, they're made up of private entrepreneur companies, and they've said, hey, wait a minute, this member caused some excitement for the reinsurer. If we have a lot of hits up in their layer, they could increase our rate the following year. They caused $285,000 of risk sharing to all the other members. And if you're asking how does that get handled, it's done pro rata based on your B fund compared to the total available B fund. And that's the other nice thing about a larger captive, is that those percentages get much lower, much better for you as a member as your captive grows. But there is a lot of risk sharing there, and they're saying, well, that doesn't seem right that we would pay this member a $20,000 dividend after causing pain and suffering to the reinsurer and a lot of risk sharing to the other members. So before they risk share that 285 to all the other members, they're going to take that 20 grand from this individual member, and now rather than risk share 285 to all the other members, they're going to risk share 265. This member would not be looking at a dividend once we get to the end of the year, or once we start paying them 3 years out, other than maybe some investment income possibly, but it won't be a really large dividend. But ultimately, the other members are helping this member out. So we did a good, we did a bad. Let's do a worst case scenario. And what you really want to avoid is frequency claims. And that would be this example. So my last example, 445 total claims, but individually they're all less than 125. They're all going to come out of this member's A fund. And we already know that's A fund is not big enough. So here's your close to 445,000 in total claims, individually all less than 125. We're short 150. Guess what? We're not going to the other members in this case, because these are small frequency claims where there's a concern that things are out of control. They're not managing their claims well. So that 150 then would be assessed back to that individual member, and they would spread that out over a 3-year period. So that 150 would get charged the following year. If this occurred in 2021, we'd start billing that 150 in 2022, 23, and 24. So we will spread it out over 3 years, because all of my examples, I'm using incurred claims, meaning we've got both paid and reserves in here, and we really don't know where that claim is going to end up. And that's another reason why we do financials twice a year, because we're going to re-true up these numbers every 6 months. But keep in mind, every year stands on its own, because I commonly get asked the question, well, can't we use some of the good years to pay off this tough year? No, they're still going to assess you on the tough year, and you're going to still get dividends on those good years. So we do not rob Peter to pay Paul. Every year stands on its own. Just think of every year with a firewall between it. They are going to treat each year separately. So that's the good, the bad, and the ugly. Because of this last example, that's why we required collateral. So I'll show you the mechanics on that pretty shortly here. First, let me just show you how the adjustments are paid. Again, I mentioned those are spread over 3 years. So the example we had where they got assessed 150,000, they're going to grab half of it the following year, and then the next 30% to get to a total of 80% up here the following year. So year 3, and then the 3 years out, or counting the year it happened, the fourth year, the final 20% to get to 100% total. So again, we are spreading out the investments. There's no reason to cash flow you to death because we know the claims are gonna, hopefully the pays will continue to go up year by year, reserves will come down, and we'll true that up every 6 months. So what is the investment? Well, first of all, you are becoming a company owner, so $36,000 would be your initial go-in capital investment. It buys your common share. It also buys your preferred share. The common share takes on all the liability, so it's a one-time initial investment. Your voting rights, your preferred shares, where all the good stuff goes. The dividends, if you want to set it up apart from the company, some companies will set it up in a trust fund, split it between the owners, or just go back to the company, but that's your call. You can get creative if you want as far as how the dividends are, how they flow back to the company. I mentioned because of that third example that you are required to have collateral, and the way the collateral works, again, it's to avoid somebody running for the hills. You can set it up with letter of credit or cash. If you do cash, you're going to get investment income on it. But basically, because of that last example, we want to have protection, or the other members want to have protection in the event somebody runs into a couple of tough years with assessments, and then they say, hey, I'm out of the captive and I'm not paying my assessments. Because again, you get 3 years to do that. So the collateral is, again, something you can set up with an LC or cash, and it's done by a formula. So the example we had, if it makes it easier, let's call this 300,000 is your A fund. Eventually, or what they're going to grab is 2/3 every year. So if I was using 300 as my example, I'd grab 200,000 for 3 consecutive years. And then you've been in the captive multiple years. Every year they're going to average your A fund amount and take that number times 2. So for this member, if we use 300 as an A fund, we'd end up at 600,000. So it's your average A fund, 300,000 times 2, or 600, that's where it would level off. Again, you can use cash, which a lot more companies are doing because of the investment income feature, or you can use a letter of credit. So if you haven't figured out, the A fund becomes pretty important. It's the biggest chunk of your premium, usually close to half of your premium if you factor in the B fund and the operating costs, but about half of it's going to be in your A fund. Worst case scenario, which I didn't touch on, but the example we used didn't get to worst case. But if you had a tough year with a lot of small claims, the most the captive can assess you is the second A fund. So 2A plus B plus operating costs. So that's your known maximum. If you want to look at it as your individual aggregate, that's fine. But that gives you some assurance that once, if you have a really bad year, you have a stop. There's a stop loss. And then, as we mentioned, the collateral, 2/3 of your average A fund is how they base the collateral. Once you've been in multiple years, you've been in 10 years, they're going to look at your 3 most recent A funds, average it, take it times 2, so they'll have a rolling 3-year average to come up with your A fund. I'll leave that last one. You guys can read that yourself. And to get some humor in there. I mentioned the captive investors fund. I'll cover this pretty quickly. Let's get to your questions. I think we're getting close to that point. Again, they are subject to the market. And actually 2020, if many of you guys remember, it started out horrible with COVID. And I've got more recent numbers that are even better now. But, as of end of February, we were at about 10% return for the 2020 year. If you go back to when this captive, the CIF, was started, since inception, it's now over 6% again, but at the end of February, it was just under 6%. So again, those are dollars. Your money is going to continue to work as it sits offshore, tax-free, until these dividends start flowing back. Cassie, I don't know what our timeline looks like. I know we're getting close to the end. Do
Yep,
you
we've
have
got,
questions?
I haven't had any questions come in yet, but if we would like to open up the session to be Q&A at this point, I'd encourage anyone who's attending and has a question for John, if you would like to type it into the Q&A feature, I will read it out. I'll give you just a couple seconds here. If anyone has
Hey,
any.
is it all right if I keep talking? Because I did want to show that existing member. So you just interrupt me if as I go through these last couple of slides. Again,
Sure.
we'll work with your broker. 5 year, we're going to need 5-year history, 5 years of exposures, financials. But here's an example of a beer distributor, upstate New York. And you can see, trying to show kind of a longer window of this member who's been in for, nowadays over 20 years. But the time we took this snapshot, it was about an 18-year window. So this first slide just shows the number of employees over that time period. They went from 100 to close to 400. And I apologize, some of these slides might be hard to read, some of these numbers. If you look at it from a payroll standpoint, about 4 million to closer to 19 million. So about a 5-fold increase in payroll. And then these next few slides just shows how that related in premium. What happened to their premium over that time? Now, again, these are going to be small numbers, but the 1999 was their first full year. They had about 227 in premium. You can see it trended up.
We had a question come in.
Go ahead.
We had a question come in, if you'd like to address it.
Yeah, go for it.
All right. John, can you discuss the idea of having to carve the liability out and just do auto and work comp? For example, still need to be subject to minimum premium, of course.
Yeah, so if I understood the question right, if we have cases where companies only have the workers' comp, we have to have workers' comp with Summit. In some cases, we only have workers' comp and auto, because a good example would probably be a manufacturer where they might struggle with the products that they're producing. And so the underwriting will still look at every single account, and if there's some issues in terms of certain classes or exposures that we can't, or they're not willing to take on, then yeah, we do have accounts with just comp and auto. Did I hit that right, or did I miss part of the question?
No, I think you summarized it very well. We had another question come in. In this particular captive for Summit, are, quote, lost time claims subjected to state statutory definitions? For example, in Wisconsin, more than 2 missed days from work constitutes a lost time claim.
And what was the first part of it? Are they what?
Is this captive, are lost time claims subjected to state statutory definitions?
Yeah, I mean, nothing's really changing in terms of, we've got adjusters when it comes to the comp side that are going to be local. So they're going to be spread throughout the US. When it comes to auto or GL, they tend to be more of a regional setup, but none of the rules really different. We have to follow the same rules, just like traditional insurance. Matter of fact, we still, or when I say we, Old Republic will still produce an experience mod, even though the actuary could care less what the X mod is. We still have to produce it. Old Republic does, because if a member were to leave the captive and go back to traditional insurance, they would need that mod. Same with, some of our contractors for bidding jobs, they need to know what their X mods are. Again, it's not something that we use to price, but Old Republic still has to follow the same rules, same as far as handling claims. The same rules have to be followed for state by state.
Thank you. And here's another question that's come in. When distributions start at year 3, are the policy years ever closed out?
So we have an internal tail fund, and that's where I said our closeout is to an internal tail fund, which is done 5 years out. At the year that they close it to the internal tail fund, the individual member is now off the hook. So we do keep a portion back that we put in the tail fund, but the individual member doesn't have responsibility. Now that responsibility goes to the group. So the good thing about the tail fund, which was set up, back in the mid 90s, that pool has gotten very large and also earns investment income. So when I tell people, hey, you're not going to see a dividend for 3 years, some cases that's been wrong. They've actually gotten dividends before that 3-year window because our tail fund that we basically keep back to pay off any potential claims that were to reopen in those old years has actually made more investment income than paid out in claims. So occasionally it gets to a high enough surplus that we have to return some of those dollars. But again, it goes from an individual responsibility now to a captive or a group responsibility, which again has been the tail fund has been very profitable thanks to, investment income and conservative holdbacks when they do close a year.
Thank you. So that concludes the time that we had scheduled for this webinar. I've noticed there are a couple more clarifications and questions that have come in. John, would you be okay if these people reached out to you directly to ask any questions?
That is fine.
Awesome. Well, we'll include John's contact information in the email that you will get with a link to the recording as well as the presentation slides. Thank you all so much for coming. Thank you, John, for presenting for us, and I hope everyone has a wonderful rest of their morning.
Thank you, Cassie.